Welcome to Part 3 of Ind AS 105.
All right, let's get right into it. You know when you're reading a financial report and a company says it's planning to sell a factory or maybe a whole division, how can you actually be sure it's a real plan and not just, wishful thinking? How do we separate a firm commitment from what might just be a distant dream? Well, the accounting world has a very specific answer for this, and it's called the highly probable test. Now, this isn't just about a gut feeling, it's a really strict set of conditions an asset has to meet before it can officially be called held for sale. And this test, it's absolutely crucial for making sure financial statements actually reflect reality.
To really get a grip on this, let's try to think like an auditor for a minute. When they see a company making a big claim, they don't just take their word for it. Oh no, they have 5 critical questions they ask to get to the bottom of it.
So picture this. A CFO makes a big announcement. We're selling the factory. It sounds pretty decisive, right? But for an auditor, a statement just isn't enough. They need cold, hard proof. And that proof comes from a very specific checklist. So, how do we verify this? Well, an auditor's checklist boils down to 5 key questions. First, is management truly committed? They'll go looking for something formal like a board resolution. Second, is there an active search for a buyer underway? And this means really looking, hiring brokers, advertising, not just sitting back and waiting for the phone to ring. Third, is the price realistic? I mean, if an asset is worth $10 million, you can't ask for $20 million and expect to be taken seriously. Fourth, is the sale expected to happen pretty soon, specifically within a year? And finally, number 5, is the plan firm? The company needs to show that they can't just easily back out. If the answer to all 5 of those is a solid yes, then the plan is for real.
And hey, here's a fun little memory trick to help all this stick. When you see HP, don't just think highly probable. As a bit of a joke among accounting students, you can think Hindustan Petroleum. It's a little silly, but you know what? It works.
Now, all of this sounds great in theory, but what does it actually look like in the real world? Let's switch gears and take a look at an actual annual report from a major company, UltraTech Cement, to see these exact principles in action.
Check this out. See how the language in their financial disclosure maps directly to our checklist? They literally say they're committed to a plan. That's our condition number 1. They've started an active program to locate a buyer. That's number 2. And by saying they expect to get rid of the assets in due course, they're signaling that they're going to meet that 1-year timeline. It's a perfect, real-life example of how these rules actually shape how companies talk to their investors.
Okay, but let's talk about that 1-year rule. We all know business is complicated, and deals can get delayed. Does that mean the whole plan is automatically off the table if it goes past 12 months? Well, not necessarily. The standard is strict for sure, but it's also practical. So, let's just ask the question directly. If a company has an asset labeled held for sale, and that 1-year mark just comes and goes, is it game over? Do they have to reclassify everything and start from scratch? The answer really depends on why the delay happened in the first place. An extension is allowed, but only under 2 very specific conditions. First, if the delay is caused by things that are totally outside the company's control, like a lockdown or a regulatory approval that's taking forever. The company is still committed, it's just that external factors are slowing things down. Second, an extension is okay if a binding sales agreement is already in place, and it's the buyer who requests the delay, maybe for something like an environmental cleanup. In both of those cases, the plan is still considered firm, and the asset can stay classified as held for sale. So, we've gone through all these details, the checklist, the exceptions, the real-world examples. Let's zoom out for a second. Why do we even have such a specific, and, let's be honest, pretty tough set of rules for this? What's the big picture here?
So why does this matter so much? Well, for one, it prevents manipulation. You can trust that a company isn't just trying to make its numbers look better by hiding an underperforming asset. 2, it gives you real clarity on a company's actual strategy. All of this builds trust in the financial statements you're reading. And finally, it forces companies to be accountable for the plans they announce. It's all about making sure what you see in a report is what's actually happening.
So the next time you see that line item, non-current assets held for sale, on a balance sheet, you'll know it's not just a label. It's the end of a long, rigorous test of commitment, action, and realism. And that leaves us with a really fascinating thought, doesn't it? If a rule this specific governs the simple intention to sell something, just imagine what other hidden stories are waiting to be told in a company's numbers.